Why panic always travels faster than money. It never starts with numbers. It starts with feeling. And by the time the numbers react, it's already too late. To understand why panic moves faster than money, we need to look at how banking actually works beneath the surface. Banks are not vaults holding everyone's cash. They're systems built on timing, assumptions, and trust. Most money is always in motion, loaned out, invested, or committed elsewhere. That design works only when behavior remains predictable. Today, technology has accelerated everything. Transfers happen instantly. News spreads globally in seconds. But human psychology has not slowed down to match the math. Fear still outruns logic. And when fear appears, money follows it blindly. Historically, banking panics were slow burns. Rumors spread by conversation and print. Lines formed over days, sometimes weeks. Even then, panic often outpaced institutional response. Banks collapsed not because they were empty, but because withdrawals arrived faster than assets could be converted. Modern systems removed friction, but they did not remove fear. They amplified it. A headline can trigger withdrawals across thousands of accounts simultaneously. A single doubt can become a coordinated reaction without coordination at all. Early warning signs rarely look dramatic. A dip in confidence, a spike in searches, a quiet shift in behavior. By the time institutions notice, momentum has already formed. Panic does not wait for confirmation. It moves on perception alone. This reality has forced banking to adapt around speed rather than substance. Managing panic has become as important as managing balance sheets. Because once fear begins circulating, money simply follows the fastest exit available. And that dynamic has shaped every major decision the system makes today. As panic accelerates, the mechanics of banking begin to work against themselves. Systems designed for efficiency become channels for rapid exit. Liquidity that once felt abundant suddenly feels scarce. The faster money can move, the faster confidence can disappear. Institutions monitor metrics constantly: capital ratios, liquidity buffers, stress scenarios. But panic does not respect models. It does not move evenly or rationally. It concentrates suddenly, overwhelming safeguards built for gradual pressure. By the time thresholds are crossed, behavior has already shifted. Technology magnifies this effect. Digital banking removed physical limits. No lines outside branches. No visible signals of distress. Panic now happens quietly, invisibly at scale. Withdrawals occur simultaneously without spectacle until systems strain behind the scenes. This invisibility creates a new challenge. Without visible panic, reassurance becomes harder. Institutions must respond to movements the public cannot see. Confidence must be restored before fear becomes obvious, not after. Timing becomes everything. In response, banks and regulators have adapted language as much as policy. Words like liquidity and backstop are deployed carefully. Statements are crafted to calm without alarming. Silence is avoided. Communication itself becomes a tool of defense. Yet panic remains faster. It feeds on uncertainty, not data. The absence of information can be more damaging than bad news. In that vacuum, assumptions fill the gap. And assumptions spread faster than any official response. This has reshaped crisis management entirely. The goal is no longer to outlast panic. It is to preempt it, to move confidence faster than fear. Because once panic gains speed, even strong institutions can appear fragile. The conflict intensifies when panic begins shaping decisions before facts are clear. Institutions are forced to act on perception rather than proof. A rumor can trigger responses normally reserved for confirmed stress. The fear of panic becomes as powerful as panic itself. Banks adjust positions defensively. Liquidity is hoarded. Lending slows. Risk appetite vanishes. These reactions, meant to protect stability, can amplify the very stress they are trying to avoid. Credit tightens. Markets sense caution. Anxiety spreads. Regulators face the same dilemma. Move too slowly and panic accelerates. Move too aggressively and signal that something is wrong. Every intervention carries a message, intended or not. Markets read between the lines, searching for reassurance or warning. This creates a dangerous loop. Panic influences behavior. Behavior validates panic. The faster this loop spins, the harder it is to interrupt. Traditional tools struggle to keep pace with emotion-driven momentum. At this stage, the system's resilience depends less on fundamentals and more on narrative. Which story takes hold first? Collapse or containment? Confidence or doubt? The winning narrative determines outcomes long before balance sheets do. This is where modern banking feels most fragile, not because institutions are weak, but because belief is volatile. Panic does not need truth to spread. It only needs plausibility. And plausibility is easy to find in complex systems few fully understand. The buildup reaches a critical point when fear becomes self-justifying. Withdrawals continue because withdrawals are happening. Caution spreads because caution is visible. The system begins reacting to itself. At that moment, stopping panic requires something stronger than information. It requires a decisive signal that fear has a limit, and delivering that signal becomes the system's defining test. The climax arrives when panic meets a boundary it cannot cross. A guarantee, a hope, a clear declaration that fear will not be allowed to finish its run. These moments are designed to be unmistakable, not subtle. When the signal works, momentum reverses quickly, withdrawals slow, markets stabilize. The narrative shifts from escape to endurance. Panic loses speed, not because it was proven wrong, but because it was interrupted. This reveals the system's central truth. Modern banking is not governed by patience. It is governed by reaction time. Whoever moves confidence first wins. Whoever hesitates feeds fear. The resolution is rarely satisfying. Panic is contained but not erased. The conditions that allowed it remain. Speed, complexity, and opacity still define the landscape. Each episode teaches the same lesson. Fear will always outrun money unless something stops it. Today's system is built around that reality. Tools are designed for speed. Communication is constant. Intervention is pre-planned, not to prevent panic from forming, but to cut it off before it spreads too far. What once felt like an anomaly is now expected behavior. Panic is no longer surprise. It is a known risk, managed through readiness rather than prevention. What this evolution has not resolved, and perhaps cannot resolve, is the underlying asymmetry between the speed of fear and the speed of truth. Fear requires no evidence. It requires only the possibility of harm, combined with the sense that others are already responding to it. Truth requires evidence. Evidence requires time. Time, in a panic, is exactly what the system does not have. This asymmetry is not new, but technology has made it more extreme. In the era of physical bank runs, fear still had to travel at the speed of human movement. People had to walk to a bank. Queues took time to form. Visible queues signaled distress, but they also contained it. The queue itself was the information. It told arriving depositors how serious things had become. It created its own feedback mechanism. Digital banking removed that feedback. Fear now spreads at the speed of a notification, a sent message, a news alert, a social media post from someone who heard something from someone else. And the response, the actual transfer of funds, follows within seconds. The queue is gone. The signal is gone. And with it, the natural pacing mechanism that once gave institutions time to respond before panic became a flood. This is why modern panic management has become so heavily dependent on preemptive communication, not just on the strength of underlying balance sheets. The balance sheet matters, but the story about the balance sheet often matters more. And that is a genuinely uncomfortable place for a system built on numbers to find itself, governed in its most critical moments, not by mathematics, but by narrative, and by whoever can deliver that narrative. Faster than fear can fill the silence. Sometimes the smallest shift in perspective becomes the beginning of a new future. That realization does not make the system weaker. It makes it more honest about what it actually is. Not a machine, a social contract, operating at speed, sustained by belief, and vulnerable always to the moment when enough people simultaneously decide. That belief is no longer warranted. Managing that vulnerability is the permanent task of everyone inside the system, not by eliminating doubt. That is not possible, but by consistently, credibly, and visibly demonstrating that the system deserves the trust it requires to function, which is a very different thing from simply hoping that trust remains, and a much harder one. Why